Welcome, everybody, to the third episode of the Pegasus Files, hosted by Acart Communications. It's very exciting that we're moving ahead with this series. I've got an amazing guest today on the show. I'm going to introduce him, Shane Curry, who's one of the principals at Curry Insurance and Investments. Welcome to the show, Shane.
Thanks for having me.
So I'm super excited to have a great conversation with you today and dive into a bunch of different things. But just for those listeners and viewers that don't really know much about your business, maybe just walk us through a bit of their history and lineage and tell us a little bit about the business.
Curry Insurance and Investments is a financial planning and advisory firm. We were founded in 1953 by my grandfather. My father succeeded him, and now I'm third generation. We specialize in retirement planning, investment planning, whether it be short-term or long-term, life insurance and estate planning, along with corporate and effective tax strategy planning.
That's awesome. And when did you first get into the business?
I have been licensed since 2006. That's when I got into the business, and now I'm licensed in Ontario, British Columbia, and Alberta. And
cool.
So we service clients in all three of those provinces, along with Newfoundland and Labrador. To date, we are now one of the largest independent financial advisory firms in Canada.
That's awesome. What's it like working with your dad?
It's fun. It has its challenges for sure, as I'm sure most family-run businesses and individuals can attest to. But, when it first started, of course, there was a lot more butting heads than back then. But, over time, you start to realize where you can have some synergy. And obviously, it's nice working with family. And after about 15 years now, it's working quite well.
That's awesome. So I guess, I'd love to just sort of bounce some comments and thoughts, get some thoughts from your perspective on COVID-19 and the global pandemic. So maybe start by, what are you seeing right now? How is the pandemic affecting, maybe we can use this as a sort of a two-part question, but how have you seen the pandemic sort of shape and affect let's start with the insurance business first.
Yeah, I mean, on the insurance side, I guess as you can see that when a pandemic or something like this happens, people start to get scared. You get scared for your own, along with your family's well-being. And of course, as you can see, based on, any sort of data sets and the news that constantly like to remind you on how devastating a pandemic and virus like this can be. So obviously that brings protection, and whether it be, things like critical illness or life insurance into the question. What we've realized in Canada is that the gross majority of the population are underinsured. So when you have this sort of situation like this happen, obviously there is a flight and a rush, to individuals to purchase insurance. And you can see that in the US, where life insurance applications have increased drastically. So that's basically, there is a lot of new applications happening for life insurance and critical illness insurance in Canada. That being said, you also have to consider ease of obtaining insurance, because there are new data sets of questions when someone goes to buy life insurance in regards to COVID, in regards to travel, in regards to if you've come into contact with anyone with COVID, or if you were diagnosed with it yourself. And any of those, if the insurers don't get a favorable answer, will likely delay your application or decline it. So that's something to be mindful of. And then in addition to that, something to also could be mindful of, I guess, is if you were diagnosed with COVID or any sort of a major illness in general, to be frank, it could cause damage to your body and to your health, in which case, if you have long-term damage, that could affect your ability to get insurance in the future, because obviously life insurance policies or illness policies are underwritten as they are applied for. And that's something to be mindful of when you move forward, if you're planning on getting insurance at some point in the future.
So, and then maybe just talk about what are you seeing on the investment side? Obviously, we can dive into this a little bit further, but what are you seeing there, Shane?
Yeah, I mean, the investment side is obviously a lot more interesting and a lot more top of mind for day-to-day conversations. When you consider the markets, North American stock markets were down about 37% as of the bottom, which hit March 23rd. since then, the market has rallied back significantly to form what is currently a bit of a V-shaped recovery, where the market is only down about 17% to 20%, depending on which industry you're looking at. Now, because they've come off so much from their highs, I mean, if we're talking about challenges with the markets, people are still negative on the average equity portfolio. And so
Right.
if you're having a long-term investment horizon of 10 plus years, this isn't something that should, keep you up at night, because you're going to have your working years ahead of you to the point where you're going to be able to invest more capital, whether the market is depressed or not. However, on the flip side of that, if you have a shorter term investment horizon, or if you're looking at retirement in the next 10 years or so, 5 to 10 years, there is cause for concern. My suggestion for anyone in that sort of situation would be to take some risk off the table and get more conservative with their portfolios currently, especially given the fact with how much we have rallied. For the market to only be down about 17% right now from its highs is quite attractive, and quite, maybe attractive is not the best word, but quite a high level in my opinion, where I think the rally is a bit overdone. I could see the market pulling back from these levels, and either way, I wouldn't be getting aggressive with equities based on this current point of the markets. I'd be taking a balanced, more conservative approach, in which case, if the market did drop again further, that will present more buying opportunities to be able to get into a more aggressive stance at that point.
So, I mean, the one thing that I've seen online is there's obviously been lots of comments from different economists and leaders and people in the financial markets, and a lot of people being asked the question, like, is this similar or dissimilar to the 2008 financial crisis? What are your general thoughts there?
Yeah, I mean, it's definitely unlike 2008. I mean, the only thing that's similar to 2008 is that the market took a hit, which will happen based on, any sort of economic issue that may occur. So in 2008, it was a financial crisis, right? The banks and population, primarily in the US, was grossly over leveraged. And, in 2008, the consequences were paid because of that. And coming into this pandemic, which has obviously caught everyone off guard, banks are much better capitalized. They didn't have the same issues that they had in 2008, and for the large majority, household debt in the U.S. was not quite as bad as it was in 2008 either. So there's a lot of it's not similar to 2008 in general, but when you consider the amount of economic damage the pandemic is currently causing, that's not to say that we will not start to see more liquidity issues and debt issues as it piles up if people are off work for a considerable amount of time and then they still have bills to pay. So that's something to be cautious of. And also one more thing, I guess, to point out is in 2008, one reason that the market dropped so much and was so deeply routed for so long was the U.S. government took way too long to do any sort of stimulus or quantitative easing. Now, when it came to this pandemic and this financial crisis of sort, or crisis of a sort, I guess not a financial crisis yet, they've learned from their mistakes. And so what that means is, as we've seen, governments have acted very fast, which they should be applauded for, with injecting money into the market and stimulating it to the point where obviously the levels of which are unprecedented, haven't really been seen on this scale since since World War II.
Okay. So what do you see, like, on the investment side? Like, I guess just sort of diving into that a little bit deeper. Obviously, there's, with what's going on, many companies have been exposed to, obviously, like, as I said, COVID-19 it's impacted everybody in a variety of different ways. Is there any common threads that you're seeing with brands that are pulling through this and holding quite strongly? Like, on the investment side, is it, a strong balance sheet? What is it that you're seeing that's able to help some of these brands sort of survive through this?
Yeah, I mean, it's a loaded question in a sense, but any company that has a strong balance sheet or basically has a a strong cash reserve is going to prevail much better than a company that doesn't, where they might not survive. So companies that have good balance sheets are going to be able to take advantage of the crisis in a sense, whether it's stock buybacks because of suppressed prices, or being able to do M&A, which is mergers and acquisitions, to be able to grow their businesses. So that's something to be cognizant of for sure when it comes to that. And when you're looking at, potential investment opportunities, everyone's obviously flying high on whether it be e-commerce or healthcare stocks, which, are great, but then they are being pressed to higher and higher multiples because there is a lot of, demand for these types of services at the moment. Typically the, more common threads of what I'm being asked right now is obviously in pertaining to e-commerce plays. So whether it be, Shopify, Amazon, Walmart's becoming a big player as well. And, rightfully so, they are performing very well during this crisis, and along with anything tech, basically, because this is being a forced move to more technology use as far as everyone's day-to-day life goes. So, when it comes to professional financial planners investing clients' money, that becomes a little bit more interesting because, present opportunities I find are more in the high yield market, with finding, good companies with good bonds to be able to purchase based on a lower risk tolerance for many people and many clients at the moment, especially where the market sits, like I previously mentioned. So, that's where I see a lot of opportunity at the current point. And then investing in equities moving into the future. Personally, I'm a bigger proponent of international equities, because if you invest in a top-rated international equity fund, the fund manager is basically given discretion to be able to do or invest wherever they want. So they can invest in companies basically in any country in the world. So that gives them a lot of leverage and free rein to be able to navigate the portfolio as they see fit, where they're not, stuck with investing in only in Canada or only in America. People that do wish to invest, more into North American equities, I would definitely suggest to be investing more of their portfolio into American equities versus Canadian equities, based on how I feel the recovery will be for those in respective countries.
No, for sure. So I guess I talk with you a lot about tech companies and technology in general, and I talk to you a lot about innovation as well. So one thing I've noticed is that lots of companies have time right now to do strategic planning, to reimagine how they're going to market. An example of that is, we're seeing quick service restaurants that are in a really tough spot right now because they're, really unable to generate the sort of revenue that they need. And it's typically a market that's also quite lean on profit. Numbers are normally pretty tight, margins are tight. And now we're seeing them do things like, doing grocery delivery services where they've pivoted into a mini grocery store, and they're selling their produce, directly through e-com or through, curbside pickup. I guess my question for you in a roundabout way is, where are you seeing the role of innovation now? And where are you seeing the role of, do you think many companies will pivot and look quite different out of this than they did going into it? What are your general thoughts there?
Well, many companies are being forced to pivot against their will, right? Where it's, eat or be eaten sort of atmosphere, unfortunately, for some of these companies that have, if you're talking about restaurants like you were, then, obviously they still have rent, they still have bills to pay, and it's a typically, low margin, but a high volume sort of business. So unfortunately, they're going to have to open up their potential revenue streams and hopefully, take advantage of this. And if we're talking about other sort of tech businesses, yes, there's certainly going to be innovators that try and take advantage of the situation at hand, and whether that be medium to large size businesses, like I mentioned before, that have a reserve of cash that's able to invest in R&D, whether it be in relation to the pandemic or, the way the world is going to look like for at least the next year and a half to 2 years until a vaccine comes out. Certainly. Again, companies are going to have to pivot whether they like it or not, and companies are going to have to continue to find additional ways to generate revenue for their businesses.
Mm-hmm. Yeah. So I guess that's kind of a good segue into, I mean, there's obviously a lot of talk on, is this going to be a V recovery? Is this a quick snap and when we're back to some of the market positions we were before, or is it going to be long and slow? Like, I guess, what are your general thoughts there?
Very, very good question. It's a very tough one. It's one I'm asked, almost on a daily basis.
Yeah,
There's a lot
I
of
bet.
economists.
I bet.
There's a lot of economists that you can, that you'll
I
read,
bet.
you'll read V, you'll read W-shaped, you'll read an N-shaped recovery, and it's, there's some scary stuff out there and there's some scary data points out there. I mean, from a general point of view, I do believe that we have a lot of volatility ahead of us and there's still a lot of uncertainty out there. So, the market is not going to find a significant rally point until a vaccine is discovered. Once a vaccine is discovered or there's some serious confidence in it, then you will start to see the market perform well before the tests are actually come out, because the market is a leading indicator. It's not a lagging indicator, so the market will be well on its way to recovery prior to the world actually looking much more normal. But when it comes to the question on, the shape of the recovery and the duration, I mean, there's going to be a lot of pain that needs to happen in the meantime, because if you look at, the vast majority of industries that have been just basically decimated by the virus, it's very concerning. And there's going to be a lot of bankruptcies, whether it be corporately and or personally, that are going to need to come out of this before, people can start to look positive to the future. Mm-hmm. Unfortunately, a lot of this economic data is going to need to come out and some pain is going to need to be felt. I mean, if we look at the airline industry as an example, because I get questions about it a lot, that's just one sector. It's a major sector, but that industry as a whole alone is losing hundreds of millions of dollars a day. So if we consider that and then how that trickles down the ecosystem where, it's affecting commodities, obviously oil and gas, and then it comes down to materials and suppliers of parts, suppliers of jobs, when people are going to travel, where people are going to travel. Tourism and the hospitality industry obviously has been demolished. So when you think of that as the big picture and how slow things are going to come, I mean, the world is still going to look a lot different, even when it comes to travel and airline travel, for the next, 2 years, maybe longer. And so when you consider that, when you consider an airline like even Air Canada, because that's, obviously more prevalent to us in Canada here, they actually had a very strong balance sheet and they have a very strong management team, but they had a strong balance sheet coming into this pandemic. But even them, they just released a loss of $1 billion in their first quarter. And, it doesn't matter what company you are as far as an airline goes, you're not going to be able to lose $1 billion or more every quarter for the next 2 years plus without receiving some sort of government intervention and a bailout. So, if that is the case and if that is going to come, no one knows what that's going to look like, what terms are going to be imposed. And, that's just, again, one industry as a whole, and it's something scary to be cognizant of. So, as far as the recovery goes, obviously we'd like it to be as fast and as wild as possible, but then there's also still going to be issues on the back end of this when it comes to the amount of national debt that every country seems to be incurring right now by injecting the amount of stimulus that they are. They need to do it. It's just what the picture is going to look like on the flip side of it.
Mm-hmm. For sure. So I guess the question you probably get asked a lot at the moment in your role is, have we truly seen the bottom? What are your general thoughts there?
Yeah, I mean, I do think we saw the bottom. We've seen the bottom. The bottom that happened when, around March 23rd, when the market dropped 30%, I did not see us retesting those lows. Obviously for some viewers of this podcast, they might think I'm, being quite pessimistic. And, I think it's prudent of an advisor to have these concerns in portfolio's and in markets. But, I do believe that a correction further can happen, but I do not believe we will get anywhere close to that low of 37%, which is basically another 20% from where we currently stand. I do not believe that's going to happen. But there is going to be a lot of volatility over the next 1.5 to 2 years, like we talked about.
Obviously looking at this from the financial literacy standpoint, we have lots of people that are, I guess, learning about finances, maybe don't know a lot about finances, and you probably meet with people with varying degrees of financial literacy. Like, so, like, what are you generally seeing? Do you think COVID-19 exposed more of that, with many families just not really being aware of what they should have been doing? Or, I mean, I don't know that everybody has a rainy day fund. I don't know if that's a thing, but what are your general thoughts there?
Well, I mean, again, that's a couple prongs to that question, but
Yeah.
let's
Yeah.
start with financial literacy. I mean, in general, I think financial literacy in the country is an issue where, many of us adults did not unfortunately learn enough about, the financial tools available to us as we
Hmm.
start our working years, along with, what we should be doing financially to prepare. In which case, that is a concern, and that is something that, people need to be more aware of on, what tools are available to them to invest. And, the government has their different tax incentives, whether it be, RSPs or tax-free savings accounts, but unfortunately a lot of people don't know either what they really are or how they really work, or what the best way of about investing is, dependent on their income and their strategy long term. So
Hmm.
that's a concern. And you also have concerns with the way that a lot of companies do their marketing and portray, whether it be the banks or where they portray financial planning. And unfortunately, that's an issue as well, where a lot of people don't know where to go for proper sound financial advice. So
Hmm.
that's an issue in itself. When it comes to coming into the crisis, yes, I'm sure that there's going to be a lot of families and businesses out there that didn't necessarily have the 3-month rule of thumb ration of cash set aside as an emergency fund, for these types of situations, or any sort of situation that may require for them to dip into their savings, where again, the rule of thumb is for 3 months of reserve to be set aside. Obviously, that's easier said than done for some. And then there's going to be a lot of, pain for the corporations and companies that, never planned for something like this, because they thought maybe their business was recession proof,
Hmm.
but obviously never thought about a pandemic.
Yeah, no, that's valid. So I guess, what do you think the post-pandemic world looks like? Do you think, like, just a general question, but I mean, do you think we're going to go back to doing things the way we were before? Or do you think things might look a little bit different? What are your general thoughts there?
Well, post quarantine,
Yeah.
obviously things are going to still be a lot different, whether it be, social distancing initiatives wherever you're going to go. If we're going to go to a restaurant, hopefully in a month or two when they're about to open back up, I'm sure they're going to be reservation only, and you're going to have distance within the restaurant, where restaurants will be operating at half capacity. Gym equipment, same sort of thing. Who knows
Mhm.
when they'll be open again? And so obviously quarantine life is going to be, or sorry, pandemic life is going to be a lot different for a long time. Post pandemic, I mean, let's just hope that things can go back to normal, where you don't need shields and masks and hand sanitizer every,
Mhm.
where you go. I mean, we can only hope that things are a bit different post pandemic.
Do you think there'll be, like, an insurgence of people investing out of this, and, like, wanting to maybe diversify, their portfolios more? Do you think there'll be maybe more of an increased appetite for looking at insurance and other things too?
Definitely, I think it's a huge eye opener for many people. Right, there's a
Mhm.
lot of people that are going to realize that perhaps they had too much money in the market and not enough money in other ways of diversifying their portfolio.
Mhm.
Same thing may go to real estate. I mean, there's still a lot of real estate owners that are obviously struggling as well, because their tenants are having trouble paying rent, whether it be on the commercial or residential side. So in general, yes, there's a lot of people that were not properly diversified, and this is going to help them, re-examine all of that. Even if
Mhm.
you look at, a properly balanced portfolio, that'll typically, consist of also some commodities like gold, where, that's more of a safe haven, and you basically wanted to be invested in at least something where there's a limited supply of, when in order to have that, balanced approach. So, and you had mentioned insurance. Yeah, I definitely believe that, good, proper, permanent insurance is very important for a diversification strategy on investments where, most people consider insurance as just insurance. So, when it comes to life insurance, you have, the typical term insurance that most people know about because that is what the banks push so heavily, which obviously will increase. It's not obvious to some actually, but it will increase as you get older. So as you get older, the premium continues to go up, to which point it becomes unaffordable and typically people will cancel it. But in lieu of that, you can actually buy a policy today. You can lock in your current age. You can build dividends that grow tax sheltered in a permanent life insurance policy, to which you can access as sort of a complementary strategy to your financial investments into the market. So you'll have your equity portfolio, but then in your insurance plan, you can have a more diversified, conservative portfolio where you'll actually make a very strong positive ROI, return on your investment, within an insurance plan. So the insurance kind of can end up becoming a free benefit, to where you also use that money built within your insurance plan as a bit of a financial retirement tool, like a pension or a slush fund for when that time comes.
Mm-hmm. So Shane, I guess like for those of us out there that don't really know how to start the ball rolling, maybe we already have a portfolio, maybe we don't. What's the general process? How would somebody get in touch with you, and how would they start the ball rolling there?
No obligation there, of course, but anyone that was interested in speaking with me specifically or my firm, they can, I believe the best way maybe would be just for them to visit our website. So it's www.curryinsurance.com, and the last name spelling is Currey. We're happy to meet with, basically anyone, whether it be, single individuals, families, businesses, and help them through this crisis. There's no cost for consultation. We actually don't even charge clients as it is. In general, we get paid basically by companies we will place business with, and we are not a fee-for-service broker, so we actually don't charge our clients anything.
That's awesome. Well, Shane, thank you so much for coming on the show. I really appreciate it, and I look forward to chatting to you again soon. Thanks everybody for listening.
Thanks for having me. It was great. Thank you.